next ratio comes your return on assets. On assets, how much is the return? The formula to be computed is net profit after tax. What is the net profit you are getting after giving tax, after tax or after deducting tax, divided by your total assets. Next ratio to calculate is your return on capital employed. How much is the return on your capital employed? So net profit before interest and tax, PBIT is being called in short form. Net profit before interest and tax. Before deducting interest and tax, what is the net profit? That amount we have to take in the numerator, divided by your average capital employed, multiplied by 100. Tip here, average capital employed means your average of the equity share capital and long term funds provided by the owners and the creditors of the firm at the beginning and the end of the accounting period. The next ratio comes your return on equity capital. This is also very important ratio, friends. Return on equity, how much return you are getting on equity. So net profit after taxes divided by your tangible net worth. The next ratio comes your EPS ratio, earning per share. The formula is net profit after taxes and preference dividend divided by your number of equity shares. So why net profit after tax and preference dividend? Because in choosing the capital, equity share capital and preference share capital holders are given the first preference while paying the dividend. The last, what is, if anything is there, it will be given to the equity shareholders. Similarly, earning per share. Per share, that means in a share, how much is the earning? So we need to calculate here net profit after deducting your taxes, your preference dividend divided by your number of equity shares. How much equity shares is there? As per that, equity shareholders, how much they will be earning in a share, we can arrive at a conclusion. So what does it indicate? EPS indicates the quantum of net profit of a year that would be ranking for dividend for each share of the company being held by the equity shareholders. Next comes your PE ratio, price earning ratio. For price earning ratio, we need to compute price earning ratio. The formula is market price per equity share, MPS, that is market price per equity share divided by earning per share. So earning per share we can calculate by getting the formula here formulated, net profit after tax and preference dividend divided by number of equity shares. By applying the formula, we will get EPS. The amount of EPS we will put in denominator to get PE ratio. So market price per equity share divided by EPS. So what does it indicate? PE ratio indicates the number of times the earning per share is covered by its market price. The next ratio comes your debt service coverage ratio. To compute debt service coverage ratio, the formula is profit after tax. After tax, what is the profit? Net profit remaining. So profit after tax plus depreciation plus your annual interest on long-term loans and liabilities will be coming in the numerator side divided by annual interest on long-term loans and liabilities plus annual installments payable on long-term loans and liabilities. So debt service covering, so coverage ratio. So PAT is your profit after tax, DEPR is your depreciation. So this ratio indicates, it's also one of the most important ratio, which indicates the ability of an enterprise to meet its liabilities by way of payment of installments of term loans or long-term loans and interest thereon from out of the cash accruals, and forms the basis for fixation of repayment schedule in respect of the term loans raised for a project. So the ideal DSCR, debt service coverage ratio, is considered to be 2. So friends, we will start with one problem here. In the balance sheet, liabilities and assets side. So liabilities, it's capital 180, reserves 20, term loan 300, bank cash credit 200, trade creditors 50, provisions 50. We will read out the assets side. Net fixed assets 400, inventories 150, cash 50, receivables 150, goodwill 50. the total amount of liabilities and assets is 800. Okay, we'll solve a problem. We need to compute here 4 ratios, namely your tangible net worth, second net working capital, third is your current ratio, and fourth is your quick asset, that means your quick ratio. Start with the first ratio, tangible net worth. To calculate tangible net worth, the formula is net worth minus your goodwill is equal to, what is your net worth? Net worth is your capital and your reserves and your balance in credit balance in P&L. So here credit balance in P&L is not given. So capital and reserves 180 plus 20 200. Okay, 200 is your 200. So your net worth minus your goodwill. Goodwill in the asset side you can see here 50. So 200 minus 50 is 150. So tangible net worth is 150. Next your net working capital. Under net working capital, remember all your current assets minus your current liabilities. In simple word. So current assets, what are current assets? Inventories 150, cash 50, receivables 150. So we can get 350 as your current assets minus your current liabilities. Under current liabilities, you can see in the liability side of balance sheet problem, bank cash credit 200, trade creditors 50, provisions 50. You will get as 300. So your current assets 350 minus your current liabilities 300, you will get as 50 as your net working capital. Current assets minus your current liabilities. Next ratio comes your current ratio. In current ratio, the formula is current assets divided by current liabilities. So what are current assets? Just we have calculated 350 divided by 300 is equal to 1.17 is to 1. 1.17 is to 1. Then comes your quick ratio is equal to quick assets divided by current liabilities, also friends known as quick liabilities. For calculating quick assets, we need to calculate your current assets minus your stock minus your prepaid expense minus your advance tax. So here only stock is given. So we will see what is the current assets. Here is 350. 350 minus your inventory, that is your stock. So 150. We'll minus there. So the balance quick asset is 200. We will write in the numerator 200 divided by your current liabilities or quick liabilities, that is 300 is equal to, we will get quick ratio as 0.66 is to 1. 0.66 is to 1.